welcome back to Learn and Digest. Today's episode we will do an article review written by Thomas Johnson and Robert Kaplan. The title is The Rise and Fall of Management Accounting. So, without wasting any time, let's check it out. In this article, it highlighted that management accounting information was produced too late, too aggregated, and too distorted to be relevant for managers to plan and to do decision making. It also said that internal accounting system focused too narrowly on producing a monthly earning report, but still, the figure fails to measure the actual increase or decrease in the economic value. The management accounting report should be a little help to operating managers by reducing the cost or improve the productivity. But usually, the productivity is low because the manager will spend more time trying to understand and explain things that have little to do with the economic and technological reality of their operations. Furthermore, in this article also mentioned about the weaknesses of management accounting system that always occur in an organization. Firstly, it mentioned that management accounting systems do not provide timely and detailed information on process efficiency. This is because they only focus on inputs such as direct labor. From this, we can see that the system not only fails to provide relevant information to managers, but it also distracts them from noticing the key factors that is important for production efficiencies. Next, the management accounting system fails to provide accurate product costs. Costs are allocated to consumer by simplistic measures, typically direct labor-based policies that do not reflect the demands made by each product on the resources of the business. The simplistic and aggregated product costing methods are adequate for financial reporting requirements, and the method used for inventory and cost of goods sold are only to satisfy the external reporting and auditing requirements. These methods are labeled as biased and distort the product cost at the individual product level. By doing this, it can lead to misguided decision making on the product pricing, product sourcing, product mix, and even the responses to the rival products. Many organizations seem to be falling to this trap. Besides that, many cash outlays are viewed by the financial accounting system as expenses for the period in which they are made, while future periods will benefit from these outlays. Substantial cash inflow for future periods may be created by discretionary cash outlay for new goods and enhanced processes, for preventive maintenance, long-term marketing positioning, for employee training and morale, and for implementing a new system. By reducing their spending on such discretionary investment, managers are under pressure to reach short-term profit targets. Thus, short-term profit pressure can lead to a decrease in investment for the long run. It is also said that management accounting system provide a misleading target for managerial attention. This is because they fail to provide the relevant set of measures that appropriately reflect the technology, product, processes, and competitive environment in which the organization operates. Financial managers, depending solely on annually financial statement for their view of the business, are disconnected from the organization's real value creating activities and fail to understand when the accounting figures no longer provide the organization's operation with valid or acceptable steps. Next, let's move on to the challenge. Vigorous global competition, rapid development in product and process technology, and large variation in exchange rates and prices of raw material demands excellence from the accounting system of corporate management. Therefore, an organization's management accounting system must provide a timely and accurate information to facilitate efforts to control costs, to measure and improve productivity, and to devise improved production processes. Accurate product costs must also be reported by the management accounting system so that the pricing decision, the launch of new products, the abandonment of obsolete products, and the reaction to the emergence of competing products can be made with the best available information on the demands for the product capital. A large organization requires systems to motivate and evaluate the performance of their managers. These systems should provide sufficient rewards and signal to managers operating in various positions with various goods and processes in the midst of globally distributed operations. Afterwards, the management accounting system of an organization should serve a vital two-way communication link between the senior and the subordinate managers. It is the medium by by which the managers convey the organization's goals and objectives to subordinate and decentralized managers. In other words, the management accounting system is said to be channel by which information about the firm's product performance and production efficiency gets reported to the upper level of the management. Plus, management compensation and promotion decisions are largely focused on the numbers stated by the accounting system for management. The article also mentioned that an excellent management accounting system will not succeed by itself in today's economy. Ultimately, it is depending on the products that meet the customer needs and satisfaction, on efficient production and distribution system for this product, and depend on effective marketing efforts. However, even the strongest efforts in product creation, process optimization, and marketing strategy can be compromised by an inadequate management accounting method. The best result happen when managers realize the irrelevance of their system and overcome it by designing customized information system with an inadequate management accounting system. However, if managers do not understand the inadequacy in their management accounting system and wrongly rely on it for details on administrative control and product decision, danger lies in wait.
Hi everyone, let's move on to the next topic, which is the opportunity. The increased demand for the excellent management accounting system occur at a time when the cost for collecting, processing, analyzing, and reporting information have been decreased. Information can be recorded in real time for analysis of operating performance. In highly automated environments, virtually every transaction can be captured for subsequent analysis. Extensive system now can accurately measure and attribute the resource demand made by each product in diverse product line. Today's designers of management accounting system can be used sophisticated electronic technology to devise reporting and control systems that are more accurate, more timely, and hence more effective than those designed by their predecessors.
Let's begin to the next subtopic. Management accounting's root began in the Industrial Revolution of the early 19th century, which is about 500 years ago. During this time, many companies were controlled by a small group of owners who borrowed based on personal relationships or their own assets. Since there were no external shareholders, there was no need for financial reporting. The early management accounting measures were simple but seemed to serve well the needs of owners and managers. They focused on conversion costs and produced summary measures such as cost per hour or cost per pound produced for each process and for each worker. The goal of these systems was to identify the costs for the intermediate and final products of the firm and to provide a benchmark to measure the efficiency of the conversion process. As a consequence of the Industrial Revolution and the ability to gain through economies of scale, it became efficient for the 19th century enterprise owners to commit significant sums of capital to the production processes. In order to gain maximum efficiency from the capital investment, owners hired workers on a long-term basis rather than bearing the cost and risk of continuous parts contracting the labor market. By the middle of the 19th century, great advances in transportation and communication, especially the invention of the railroad and the telegraph, provided further opportunities for gain to large, which is the hierarchical organizations. The final developments in management accounting systems occurred in the early decades of the 20th century to support the growth of multi-activity, which is diversified corporations. The DuPont were produced and was formed in 1903 and combination of previously separate family-run or independent companies before DuPont. Before DuPont, organizations engaged in only a single type of activity. At last, a consequence for many decades, management accountants increasingly focused their efforts on ensuring the financial accounting requirements were met, and financial reports were released on time.
Okay, everybody. Next, what we're gonna talk about? We're gonna talk about loss relevance. All management accounting practices had developed to serve the informational and control needs of managers of increasingly complex and diverse organizations. Without significant innovation in the organization forms, the diversity of the products and complexity of the manufacturing processes continued to increase in the decades after 1920s. The need for accurate product cost and effective process control should have imposed new demand on organizations' management accounting system. The evaluation of management accounting system after 1920s did not keep pace with the improvement in corporations' product and process technologies. These lag eventually led to today's problem, which distort product costs, delayed and overly aggregate process control informations, and short-term performance measures that do not reflect in the increases or decreases in the organization economics positions. As corporations' product lines expanded, as production technology changed, as product life cycles shorten, as global competitive conditions shifts, and most importantly, as a great advance information technology occurred. We should have expected a consideration of the decisions to not invest in more relevant and more timely management accounting system. In fact, when cost system became automated on the digital computers starting in the middle 1960s, the system they found in the factory left unquestioned was whether this system was still sensible given in the great expansion in information technology represented by electronic digital computers.
Academic led astray. The article believed academics were led astray by focusing too narrowly on simplified model of a firm behavior. The result influences strongly found little value in cost allocation imposed on organization by financial accounting procedure. Literature emerged advocating the separation of costs into a fixed and variable component for making a good product decision and controlling interest. When illustrated in the simple one product setting used by academic economists and accountants. However, they never fully address the question of fixed costs. The fixed costs come from and how these costs needed to be covered by each product in a corporation repertoire. Nevertheless, the academic researchers come out to implement their idea in the actual organization with a large number of products and complex multi-stage production process. Ironically, as a management accounting system become a less relevant and less representative of organization, operation and strategy, also dominated by senior executive when they believe can handle the firm by the number. Lacking knowledge and uncomfortable with their firm underlying technology, they look at projecting short-term impact when making decisions and financial measures, especially for earning per share and return on investment. But as a product life cycle are shortened and more costs incurred before production begin, directly traceable product costs become a much lower fraction of the total cost. Consequently, traditional financial measures such as predict earning and accounting return on investment (ROI) become a less useful measure of corporate performance. Accounting for caravan. Let me tell the definition of caravan is a group of people, especially traders or pilgrims, traveling together across a desert in Asia or North Africa. In the 15th century, and publication of original accounting book by Prapasholi, what kind of events were occurring that lead to a demand for accounting information? Undoubtedly, merchants in Venice were trading goods with other countries. The article given an example by acquired produce in northern Italy and chartered an expedition to sell in India. The trader purchased the tea, traveled back to Venice and then sold the tea. At the end of the progress, the accounting subtract the cost of caravan and cost to acquire the initial lot of merchandise from the sale to compute overall profit for the entire trip and to distribute among initial investors as a role of accounting. Investor understood allocating the total profit of expedition to a period short term as 3 months was not meaningful. Debating that meaningless to allocate project profitability to short-term period within life of project doesn't imply the article believe it fruitless to own valuable indicator of short-term progress. Back then, Venetian expedition during third quarter of 1487, there are many indicators that investors were interested in knowing. For example, what distance caravan cover, what direction, how many provisions are left, and what is condition of inventory being transported. Current competitive technological environment probably indicator of company short-term performance that is a quarterly earning. Cash flow is important. Know the pattern and structure of the company cash receipt and expenses with amortization, capitalization, and many accrual.
The last subtopic in this the rise and fall management accounting is innovation. In recent years, however, new economic forces have led to many important innovations in management accounting. Most companies use traditional financial metrics like market share or return on investment (ROI) to value innovation opportunities and investments. Back in the 19th century, only top managers are using this method because it is very useful to help direct their allocations of capital and to evaluate performance of the operating department. Thus, the ROI measure played a key role in permitting this internal market for managers and for capital to function. In the finance and accounting industry, innovation could mean moving away from traditional bookkeeping and compliance services and looking for more ways to add value to your client's business. Lastly, to remain competitive, CEOs should develop efficient strategies to promote open collaboration and creative thinking in their firm, while remaining nimble enough to address the demands of ever-changing market trends. Without a doubt, accounting firms and CEOs should keep abreast of the latest innovation in accounting and finance if they do not want to go to the way of the buggy whip makers. Thank you for listening to the talk, listen and digest. Thank you.